When government creates a problem, onerous taxation, and then turns around and grants you an exception to the problem they created, any tax qualified plan, aren't you just a little bit suspicious that you are being manipulated? Tax qualified retirement plans were all created under the guise of giving you a break. First, there were pension plans for corporate employees, and then came HR 10 plans for partners and sole proprietors, and finally, IRAs for individuals. Now, everyone had an exception to the IRS code. If the government really wanted to give you a break, all they had to do is cut out the taxes. Do you really think that they want to do that?
Now, that's a good question. Welcome to the Bankless by Design podcast, where we rethink money, ditch the system, and rediscover what it means to truly thrive well. I'm Trisha Miller, mom of 7, financial coach, and founder of ThriveWell. Around here, we believe wealth is more than numbers. It's about freedom, stewardship, and building a legacy that lasts. If you're ready to challenge the norm and take back control of your financial life, you're in the right place. All right. Well, welcome back to the Bankless by Design podcast. Today, Jonathan and I are here, and we are going to try to finish up page 85 that we started last week. Again, just to recap, this particular page in the 5th edition of Becoming Your Own Banker was actually written by David Stearns, who I had the pleasure of being on the Infinite Banking Initiative podcast, actually, that was just published last week. So if anybody wonders who David Stearns is, you might want to look up that podcast, and then you can get a little bit familiar with David. He is Nelson Nash's son-in-law, and he wrote this particular page. So I believe, if I'm not mistaken, Jonathan, that we left off on point number 4, right? Under points to consider?
Yeah, I believe so. Would you like me to go ahead and read it?
Yes. Let's just dive right in.
All right. When government creates a problem, onerous taxation, and then turns around and grants you an exception to the problem they created, any tax qualified plan, aren't you just a little bit suspicious that you are being manipulated? Tax qualified retirement plans were all created under the guise of giving you a break. First, there were pension plans for corporate employees, and then came HR 10 plans for partners and sole proprietors, and finally, IRAs for individuals. Now, everyone had an exception to the IRS code. If the government really wanted to give you a break, all they had to do is cut out the taxes. Do you really think that they want to do that?
Now, that's a good question. Okay, let's just back up. I think the very first question he asks there is just so good that we have to just let that question simmer for a second. When government creates a problem, I mean, they're the ones who are taxing us, right? And he says in parentheses, onerous taxation. So this isn't a little taxation. So when the government creates this problem and then turns around and grants you the exception to the problem that they created, aren't you just a little bit suspicious that you're being manipulated?
I think you should be.
I don't even know if there's much that we need to say about that because...
Well, I think you could just go the same train that I took us down in the last episode on one of these points where I was trying to, I think about banking, where I was trying to get everybody to zoom out and really think about the actual concept of what they were doing. Same thing here. It's like the rat in the maze, right? You put the little piece of cheese to go figure out where you're going. Like, aren't you a little bit questioning of like, where'd this cheese come from? I don't know. I guess what I'm trying to explain is that you should be a little bit suspicious when somebody is giving you the solution to the problem they created. I mean, it's just that simple, right? It's like, what's it called? Hitting you with the left, but healing you with the right. It's something like that. I can't remember the analogy.
A little bit like the fox guarding the hen house.
Yes, exactly.
Yes.
Much better analogy.
Well, no, I like the cheese in the maze. Like, where did the cheese come from? Where is this little temptation, this exception? Why? Why is it there? And why can't they just simply cut your taxes?
I've seen a couple political slogans recently about making X cheaper or making blank more affordable. That's a very common political mantra so to use, or fill in the blank, right? I just think it's always interesting because it's like, well, if you did, I mean, we pay over 30% of our income in taxes. That would be quite the pay raise for everybody if we got any of that back. I mean, even half of that, right? 15% pay raise to everybody would make quite a difference at the moment. And I think the thing there is that it's always like, oh, well, my taxes are going to something useful, so it's okay. But I think when you actually follow the money, you find out that your money's not going to contribute to something positive that you might hope it is. And at that point, yeah, why wouldn't you just cut the taxes if you actually wanted to make something more affordable? But why would the beast ever stop wanting to eat?
Right. And it's interesting, these tax qualified plans also, when it asks the question, aren't you being manipulated? Where'd they come from and why? Well, if you think about it, your money, if you're putting it into these tax qualified plans, the enticement is we're going to have your employer give you a match, and it's also going to give you a break on your taxes now. But what is that break on your taxes now costing you in the future?
Yeah, because aren't you going to have to pay taxes on that when you pull it out anyways?
And would you rather have your tax on the seed or the harvest?
On the seed.
Yes, it's going to be a lesser amount. We assume that we're going to have lower taxes in the future, but that's like planning to fail. That's like planning to be poor, because in my way of thinking, that's the only way taxes are going to be less for you, especially when you consider that when you go to take your money out of these plans, you might have your house paid off. So now you don't have the mortgage deduction. Your kids are certainly out of the house, so you don't have the child tax credits or benefits of that, right? So all of those things are gone. So now you are actually probably subject to the most tax that you'll ever pay. And that assumes too that the government isn't going to increase those taxes going forward.
So yeah, with tax deferred payment plans, it's one, to your point, it's assuming that taxes are actually going to be lower in the future, or it's assuming that you're going to be in a lower tax bracket, which when you're retiring, you'd hope that you're actually in a higher tax bracket because you better hope you have more money coming in.
Exactly. And I think there's a couple of things people don't think about here. And one is that you're putting all your money in there and you're the one who's bearing all of the risk of the market on those dollars, of which a good chunk is going to the federal government later on. So you're bearing the risk for 100% of it. And by the way, you're paying fees on 100% of it. So you're also paying the government's share of the fees. So the government has actually set up a really nice savings account for them. If you really think it.
Zero risk investment plan for themselves.
Exactly. You take all the risk, you pay all the fees, and then they get their portion when they're good and ready, when your nest egg is bigger. So when you really start thinking all of those things through, then we have to start saying, aren't you just a little bit suspicious that you're being manipulated?
To give a practical real life example, I even came to you as a young person getting into the workforce. So 401k is very heavily pushed on me as something that I need to be, contributing to as much as possible, that I should be putting as absolutely much as I can bear to, pretty much. I mean, that's even what, my associates tell me and things like that. But the reality is to your point, I'm putting money away now that I can no longer use. And I'm hoping that at some point, one, the taxes will be lesser on what I'm putting in there than what it is now, but also just that that's going to be enough. And at the same time, I'm literally locking away dollars that as a young person who is quite risk averse, I could be going out and using and multiplying and doing much more with than what a 401k is actually going to most likely do in the meantime. And I can be doing other things with that money at the same time. So I even came to you and was like, well, Mom, shouldn't I be taking advantage of at least my company's match? And you were like, well, that's just paying the fees. So it's really not like, okay, it is free money. And that's how it's pitched to me too, especially in all of my HR meetings and things like
free
that.
Money.
Yeah. Take advantage of your free money, at least do your company match. Shouldn't I diversify? Isn't that a good idea? If I'm just putting 2 or 4% into this, okay, like what's the big deal? And you're like, well, that's fine if that's what you want to do. But wouldn't you also rather put that money into your banking system that you could actively use and that would also have a compounding growth rate eventually, and then also be available to use today and recapturing your own interest on it, and somebody else isn't profiting off of that? So sounds like a pretty great deal to me. It's just something that I didn't even think of, because again, my basic high school economics and college economics brain was like, well, I should diversify. I shouldn't put all my eggs in one basket. But when I actually have my own financial system, why wouldn't I just put that money into my own system? So.
Okay, I just want to make one caveat here to my listeners. This is not in any way to constitute financial advice about your 401k. This is a conversation between my son and I. And so any advice that he has received has been from me as his mom. Okay. And this is just educational, but it is not to be understood as advice. Okay. So I just want to make that caveat. So one point that you bring up that I want to mention here is this idea. You mentioned that your money is locked up. It's behind penalties and taxes. And we are all conditioned to feel like we can't touch that money. In fact, we don't trust it. And maybe it's because the government knows better and we don't know how to handle our money. And therefore it's better off in somebody else's hands because we can't be trusted not to spend it before retirement. So for 40 years, essentially, this money is locked up and inaccessible to the average American. And sometimes when I see people with hundreds of thousands of dollars that have been locked up for years, all I think to myself as a real estate investor is, do you know how many houses, apartments could be purchased with some of that money and bringing in cash flow? I'm just saying there's just simple things you think about. And I know that's not everyone's DNA, right? But just the fact that it's like your hands are tied behind your back, unable to touch the very capital that could bring you financial freedom, in the hopes that one day, someday it will be enough, and in the hopes that the market will always go up, and forgetting the tax consequences and the fees. And there's just so many pieces to this that people just need to really consider all of that when they're considering the benefits of those qualified plans. All right.
I think you hit on a lot of key points there. And I think so much of the 401k style investment and, let's say, US success path plays so heavily into this scarcity mindset that all of us have, where we don't trust ourselves to save or to do well enough. And, well, maybe Big Daddy government can do that better than I can, so I better trust them with my money. I think that it totally plays into our brain where we're like, I must put it away. And I heard you in a podcast today that I was listening to talking about, living for one day, someday.
Exactly.
And that's not to say that saving and being careful with your money is not a wise thing to do. You should. Absolutely. Do not hear me wrong. But this totally circles back to point number one, the average American family. Is their money working for them when they're struggling? And that's the thing, is I think most people's money's really not working for them.
This also brings up this idea that people have it in their minds when they're putting it in those qualified plans, that that's a savings account.
Yeah, exactly.
And it's not savings. It's an investment at risk, and everything is going great as long as it's going great. But when it's not,
I think just now everybody's recovering from the COVID crisis on their 401ks.
And then you have to time the market right. And none of us has a crystal ball. And then this idea of waiting for one day, someday, even when you get to someday, now you got to start taking it out and withdrawing. And should there be a crash, now you're almost in retirement in this scarcity mindset going, I better not spend too much because I have to make it last the rest of my life. And unfortunately, a lot of people don't really realize that these qualified plans have really just come around since 1980. So he talks about this in here a little bit, how they were pension plans. Pension plans were actually largely done through the life insurance industry with 100-year timeline, and people who were trained in being pension managers, and they had large pools of money to work with so that they could have guaranteed income for life. And they knew how to plan that for guaranteed income for life. But when this 401k idea and IRAs and all this came about, essentially it made all of us our own pension managers without the benefits that the pension manager had, because we don't have 100 years plan. We don't have such a large pool of capital that it isn't going to hurt anything when some people retire. Instead, it's going to affect our entire pool of capital. It's a much smaller pool and it's at risk. If it's in the market, it's not the same as having it have been, whether that was annuities or life insurance. They were in the business of guarantees. And so it's just changed everything for people. They don't realize it's the new kid on the block, and it has put you and your future in a tremendously risky position compared to anything our parents or grandparents had, with the exception of some remaining pension plans today. Okay. But everyone got their exception to the IRS code. I'm just looking here back at this paragraph. So let's just talk about real quickly here, the IRS code. Where did this come from? Again, back to your analogy of the maize and the cheese. Where did it come from? Have we always had the IRS?
No.
No.
IRS and I can't remember if the IRS was founded at the exact same time as the Federal Reserve in 1913, but the federal income tax did not exist until that time. And so the government was funded through bonds and through things like tariffs, and I can't remember quite else. But yeah, so there was essentially just only like a 2% tax, right? For the standing army tax is technically the only constitutional tax that we actually had. So there was a period of time where the government was funded without direct federal income tax, and it was actually ruled unconstitutional numerous times, time and time again, that it was unconstitutional to tax you, the woman, or me, the man. And the creatures of Jekyll Island, as they're called, found a way around that, as did the bankers and the lawmakers. Follow the money. But the reality is that there was a time before these taxes, and there was definitely a time before onerous taxation. There was a time where maybe taxes did start out with maybe good intention. And I just think, like anything, unfortunately, it was corrupted and misused. And now we find ourselves in a position where we're paying 30 to 40 to potentially more in taxes in a country that was supposedly founded on no taxation without representation. Right. And that revolted apparently over a 1% T-tax or a 2% T-tax, whatever it was. And yeah, I think there's just the sad reality is that through legalese and through deceptive means, truthfully, and through fraud, the powers that be have found a way to, quite frankly, steal from you and to directly steal your hard-earned labor in order to do what they wish to do. And I think that if more people were aware of the reality, there's an amazing quote. Who is it? Is it Edward? No, it's not Edward Mandell House. Who is it that said if the American people knew the way that our financial system worked, they would be a revolution
Ford.
Tomorrow?
If Henry we understood Ford. Banking.
Yeah. Okay. I'll paraphrase it. It's something along the lines of essentially if the American people understood the way banking and the financial system works, there would be a revolution tomorrow.
I think people would be surprised sometimes to even consider that our country ran for well over 100 years without the IRS and almost. Income tax. And you mentioned taxation as theft. And I will say we get a little bit of the flavor here from this page about Nelson's philosophies and his beliefs, both economically. He was an Austrian economist who is definitely someone who believed in the free market and less government intervention. And of course, the Austrian School of Economics is very much opposed to the Federal Reserve and the manipulation of interest rates. But I wanted to mention here, if you will, Nelson has another book called The Warehouse of Wealth. And this book is largely a walkthrough of the Old Testament and how he saw the role of government and taxation. And this one paragraph is probably the most prominent in my mind. I have it underlined in the book. And he's talking about when the Israelites are finally freed from slavery in Egypt. And he says, now they are free of Egypt, free at last, free at last. And where had God put them? Sinai. There was nothing there to sustain life. Nothing. This is where God put them for the next 40 years to teach them to be dependent on him. It would be impossible for them to claim sustenance from any other source. Their minds had to be cleansed from the idea of being a slave. And that right there speaks to this mindset. Rethink your thinking. We have been conditioned to think certain ways, and slaves don't know how to be free people. That's what he's saying here. Their minds had to be cleansed from the idea of being a slave. They had to learn to be free people indeed and put their trust in God, not government. No government programs. Remember, there is a very strong element of dependency in the act of worship. You will worship that on which you are dependent. All governments want you to be dependent on them, not God. So,
is there anything else to say?
Just to give you a little flavor of Nelson, he was very serious and saw, I think, his Austrian economics, his Christian views all mixed in. And I think the infinite banking concept aligned with both very well. Of course, the Austrian economics being one that is very much in favor of free markets, freedom from government intervention, whereas the predominant economic thought today is Keynesian from John Maynard Keynes. And the Keynesian school of thought is really about let the government go into more debt. So it actually increases government debt in the idea that that is somehow going to boost the economy. And it is pro central banking and pro Federal Reserve. And so it's interesting that the Keynesian school actually blames, the Austrians and even the Chicago school, I believe, of thought where it's less government of creating booms and bust cycles. And yet what have we actually seen since the Federal Reserve but a boom and bust cycle all the time?
I would beat one last point.
Okay.
My last point on that would be that slavery never ended. I think slavery's in the United States, in the enslavement of direct peoples. Yes, that went away. I think slavery still exists worldwide, but what we have changed to is a debt-based slave system. The powers that be found out that ruling with the iron fist doesn't really work out so well. It eventually leads to things being burned down and pillaged and the people uprising against you. And so, quite frankly, they are insanely intelligent and have found the most deceitful and deceptive way to control and manipulate all of us. And we live in a debt-based system that puts us basically all at slaves to debt. And I just think it's a really unfortunate reality that most people aren't even aware of. They're, quite frankly, a cog in the machine that contributes to the beast. And I just think it's something that people should really spend time looking into and to understand and to recognize the level of control that the financial system we live in has put us under, and that there was a time where that wasn't the case, where true sound money does not allow you to manipulate markets and people the way that the fiat currency has. This ability to print and create money out of thin air, it's created the Leviathan, like this beast that cannot be stopped and will not be stopped. Once it's gotten that point, it won't end. And
nor do they want it to stop. And I think that's a misunderstanding. Oh, we're in so many trillions of dollars worth of debt. Some political party has to put an end to this debt, has to get out of the debt. They don't want to get out of the debt. They can't. The entire system would fail.
It's built on it.
It's built on it. Yes.
I think it's a better way to look at the national debt is how much money we have printed. Just look at it that way. Rather than it's something that we owe to China, I think is a very common misconception. It's that it's owed to some other nation or something like that. And it's owed to a series of banks, conglomerate international banks. And yeah, so it's just very interesting. I think a good way to look at that counter is how much money has the Federal Reserve printed? Yeah. So I think it's currently like $45 trillion, something like that.
It's crazy. I know.
It's probably higher than that actually now.
Well, you can look at that debt clock and it's frightening to take a look at that. The last I heard it was in the 30s. So if it's hitting the 40s, I haven't looked at it in a while.
Yeah, I know it's just an exorbitant amount.
It becomes too much for the mind to even imagine. So then what can you do with that?
You can't even conceptualize what trillions look like. But I'm not somebody that likes politicians or anything like that, but I do think Thomas Massey's a pretty decent person, and he actually wears a little pin that is tied to the national debt, and it constantly goes up. It's a little digital national debt.
Oh, wow.
And he wears it around at Congress and when he's on the floor, and it's insane. It's real time. It's real
No
time and it's
kidding.
constantly going. It's pretty crazy.
So a good reminder to everyone he's looking at.
Yeah. Yep.
That's something else.
Sorry, Mama.
Okay, let's go on to number 5.
Point number 5. Wealth has got to reside somewhere. Where would you prefer to have it reside? Real estate? Then take a look around and see what happens when one needs liquidity. Real estate is very much a frozen asset. The stock market? Then try reading from my recommended reading for those interested in the stock market on page 91 in this book. And if you haven't seen it, it's quite a list. Until you have done so, are you qualified to make an intelligent decision about such action? Or free contract with other free persons, life insurance, and from this base of financial operation, you can do any of the other things in life that you desire.
Like still invest in real estate or still invest in the stock market if you must.
I think a great way to look at this one, if I may, would be, and this is something that you've really helped me try to formulate in my mind, is that the life insurance and the infinite banking policy should be used like a filter in which I pass through all of my money first. So like if I'm going to go and use this X amount of money for paying down my credit card or to go buy a boat or to start a business or whatever it might be, it could be a small amount, it could be a large amount. But if I have the ability to, because of paid up additions or whatever, I should be taking my money and just putting it through my system first. So I capture the interest from it and then go utilize it in other ways. I don't think it's necessarily don't buy real estate. Oh, don't get involved in the stock market. But it's more so just saying, shouldn't you try and capture and create that larger pool of your own capital and your own banking system and then go and do these things and not relying on those things as being your only means, I think.
Right. Because the infinite banking concept is essentially like buying a cash flowing asset that is going to act as a place to warehouse your wealth. Thus, this very beginning, wealth has to reside somewhere. It can reside under your mattress. It can reside in the bank downtown. It can reside in real estate. You have equity in real estate. That's what it's talking about. It's frozen because it's not liquid, right? Not liquid quickly. You'd have to go to the bank and get permission to take a loan against it, or you'd have to sell the house to get that money out of that asset. So the dividend paying whole life insurance with a mutually owned company is really truly free people contracting with free people to pool their money together in a place where it's going to grow for the rest of your life. It comes with guarantees and it leaves a death benefit. So it even makes future generations better. It acts as a hedge against inflation. It acts as a hedge against taxes. It's growing tax-free. So it's a great foundational piece. And from there, you can actually have access to capital. Your hands are not tied behind your back, waiting for one day, someday, for your money to grow enough to you finally to touch it. No, instead, you can borrow against it now. It keeps growing and you can go do all of these things that you need to do as well. So it is a little bit like you have to have a place to put your vehicle. So we build garages. We go park our car in the garage and then we take it out the next day and go do what we need to do. And then when we come home at night, we park the car in the garage. It's a place to store your money. It is not an investment like your investment in real estate, but it sure does give you a great foundation where you can access those dollars to be able to use them. And I say access to capital, which is an intentional term. And I know when I first got into the infinite banking concept, I wasn't real sure what somebody meant by capital. What do you mean? Not just access to dollars? Well, we've talked about there's a difference between fiat currency and capital. Capital is something that has value, intrinsic, right? It's the value inside your policy. It is growing every day because it must reach that death benefit. So just like your house, it's not the equity in your house. They're not actual dollars. There's a value there. The value is whatever the market price would be when you go to put it up for sale, minus anything you owe on it, right? That's your equity. It's a value there and you can collateralize that value. So But getting back to the fact that this is a mutual policy with a mutual life insurance company, that means that it's free people, private contracting. You can get a sense of that Austrian economics there too. That's why it goes so well with that school of thought, because it is private. It is no government intervention, essentially. So you are free to function and to borrow at will. There is nobody going to tell you no to the amount that you have available there. There's no application process. So making it a great place to store your wealth while it grows the whole time.
And not only that, but it's money that you'll see again. Whereas when you go and just pay something in cash or pay something directly, it's money that you'll never see again.
Right. It's gone forever. You're absolutely right. And then upon your passing, it can flow down to the next generation, setting them up in even better shape than the first generation.
I think it's funny that there's so much good and so much practicality with an active life insurance policy, just utilizing what it can be used for in your day-to-day basis, that you forget that it's almost like this wonderful little surprise at the end that there's a death benefit also attached.
Yes. I think
almost forget about that.
It sometimes it's like the icing on the cake, and yet it's a huge piece of that. Like, that's just tremendous.
What an incredible thing to leave.
All right. Shall we move on to number 6?
Yeah, that was well done.
All right.
Point 6. You finance everything you buy. You either pay interest to someone else or you give up interest you could have earned elsewhere. There are no exceptions. This gets right back into what we were just talking about, where I just said money that you would never see again. So here, what we're basically saying is that you either pay interest to somebody else by taking a loan from the bank or by paying with your credit card or whatever means of utilizing somebody else's money, right? Or there's people that only pay cash for everything. And this is something that I think is much harder to just immediately think of, at least without taking one step back potentially, is the opportunity cost of using cash. Is that you've lost the ability to gain interest on that cash in whatever means, whether loaning it out to somebody else, whether investing it, whether putting it into whole life insurance, whatever that might be. And I think that's a big thing that I had never even really considered until actually reading this. And then also I think Warehouse of Wealth elaborates further on that point as well. And it was something I really truly hadn't thought of. And I don't think most people think of as the opportunity cost of using cash, because we just think that cash is king and that it's best because I'm not going to have debt off of it.
Right, right. And we just assume that we're saving money when in reality, our dollars need to be working for us. Wealthy people understand this. Wealthy people know that our dollars should be going to work. But when we spend them, we just fired them. They can no longer work for us. So if we have the ability to put them to work for us for the rest of our lives and still use them, that's just incredible. But you're right. We don't usually think about the opportunity cost. And just speaking of Austrian economics for a second, I just learned recently that opportunity cost is something that the Austrians definitely took into account and has now only more recently has become a pretty standard practice to consider in business today. So we think of it in business now, but we don't recognize our own personal finance, that it should be valued just like businesses value their capital. Just like banks value their capital, we need to value ours. And that means taking into account the opportunity cost of our dollars.
And I think that's where you could even just say, I recognize that even amongst my family. I think it's very easy. And this comes with stealing the peas. This goes back to another key point, is that it's so often, especially say when we're doing family banking or something like that, to think, oh, well, just give me a interest-free loan, right? Just whatever it is for that time being. And I think that there's times where if it's a quick enough transaction that's warranted and so on and so forth. But the reality is that I've even offered this to you, I know before, is that I recognize that even if you spot me $1,000 for 2 days, that's $1,000 that you cannot utilize for 2 days. So there's some value that you there are giving to me. And right. So even if I'm like, what's the cost of capital? So it's like, Oh, I could give you $25 to spot you the 2 days. That's 2.5%. It's nothing crazy, but you get my point. What is being done here, and what's the opportunity cost for you and for myself? And also, it's interesting because we think about it in business sense, and then sometimes we think about it in personal finance, but also it's our every single day, how you choose to spend your morning. You're choosing to, okay, are you going to go for the run? Are you going to sleep in? Are you going to have the full breakfast? Whatever, right? Or are you going to go spend your day doing something you wish to do? Or are you going to spend your day doing something that you maybe don't want to do, but that's going to eventually make you more money down the road, like working on a business or something, right? So there's the opportunity cost in our own personal lives and the way we choose to spend our time. So,
yeah, in lots of areas. And that is one thing Nelson's always really good about in this book. And even in my conversation with David Stearns recently, that he emphasized is that Nelson was never talking about just finance. Most of his principles that he talks about in this book are for all of life.
mm-hmm.
So touched on that just a little bit there. All right. So number 7.
Point number 7. Your need for finance during your lifetime exceeds your need for life insurance protection. If you solve for your need for finance through life insurance cash values, you will end up with so much life insurance that you can't get it past the underwriters. You will have to insure every person in which you have an insurable interest.
All right. So your need for finance. What is our need for finance?
I mean, at least for me, your day-to-day life. I mean, I think it's apparent to most people, at least it ought to be. I think the majority of Americans are living paycheck to paycheck. And you recognize that your need for finance, whether it's affording your groceries each week and the ability to put food on the table or to keep the house warm, but also the unexpected things that happen, the birth of a child, perhaps, or, or something just like a car accident, or these things that maybe are planned for or maybe aren't planned for, but your need for finance is immense. And it's definitely always going to be so much greater than you actually anticipate, right? There's always these things that come up. And this is why you talk about the emergency fund in high school economics. It's because life has unexpected things that occur. I think.
And even expected.
Yeah, even expected.
Expected things are expensive.
Yeah, exactly.
Houses
So,
and cars, we have to have food and shelter. And
yeah, I can't remember the number for it, but it's something like the average person is expected to create like $2 million of value in their lifetime. But then I think it's something like the average person has, I'm going to totally get it wrong, but it's millions of dollars flowing through your hands that have funneled through you and either been paid to bills or paid to whatever. And when you actually step back and look at it, it's quite mind boggling to think about how much money that you've had and then it's gone, and you've had and it's gone.
right. So if you solve your need for finance through life insurance cash values, solving that need means that I no longer have to go to a third party bank for any of my needs. That's a lot. That means I can buy my cars by borrowing against my own cash values. I can one day buy a house without having to go to the bank for a mortgage payment because I can finance it myself. That's the idea of solving for your own needs of finance in your life, no longer going to those third-party banks. If we can do that, that means we have to build a system big enough. And Nelson said this is not just one policy. This is talking about multiple policies, which he gets to here because he said you will end up having to have so much life insurance that you can't get it past the underwriters because there are limits to what you can get past an underwriter. So you have to have not only insurance to the max on yourself, but you're going to be looking to get insurance on your family members, your business partners, anybody that you have an insurable interest with, perhaps your grandchildren. I mean, the list can go on.
What is defined as an insurable interest?
So an insurable interest is, I would experience a loss if this person passed away. So if it's my spouse, I'm going to lose all that they brought into the marriage equation. If I lose a child, I have expenses, and those expenses go beyond just funeral expenses, but the amount of insurance on a child is going to be dependent upon how much insurance you have on yourself. You can only do up to 50% of the amount of insurance you have on yourself, but on yourself, there's definite limits based on your income and your age. But if I am going to experience a loss, Now, so that can be a business partner, right? If I've got a business partner who's contributing to the business and their skills are needed in order for the business to succeed, that's an insurable interest. So Nelson is saying you've got to have insurance on everyone that you're going to have an insurable interest in order to solve for this need for finance. But as a result of that, you will have so much death benefit. So this is where sometimes I think people think, well, he don't care about the death benefit. Well, no, he does care about the death benefit, but the death benefit will essentially take care of itself when you solve your need for finance.
I think a good way for people to think about it is just like you have to build like a little web and a system of policies in order to max out to a certain point, because basically the life insurance is going to max you out based on your expected ability to produce income right through your life is what they base the numbers off of. So there is a certain maximum amount that they're going to anticipate that you're going to actually be able to contribute. So at a certain point, you have to start corralling in the people that, to your point, that you have an insurable interest in. So whether that's family members or business partners, and then you still have access to those policies, to that capital. And it's just, if that person then does unfortunately pass or something like that, then you have an unexpected windfall, and then you better go buy more policies with it.
And that's what Nelson did. He said, that's how you diversify. You diversify with lives insured. So he had multiple policies on all of his children, his grandchildren. He had policies on business partners, some whom he was only a partner with for a short while. And down the road, he'd even lost touch with these people. But I know at least one of them passed away. And he said that makes up for a lot of financial mistakes in your life. So there is that system of policies, just like there's not just one bank on the corner. There's many branches in town. So if one banking system is profitable, how much more is another one? And so multiple policies at the end of the day. So
is it the underwriter who decides if you have an insurable interest in somebody when you go to create a policy on them?
Well, there are some standard insurable interests, like I said, like, spouses and children, and you have an insurable interest in yourself. All of those are automatic and for sure. But there can be situations where we basically write a cover letter and we have to argue for insurable interest, and we give the facts behind it. And then, yes, it is decided upon whether or not you actually have an insurable interest there. All right. Well, I think that we wrapped up page 85 pretty well. What do you think?
Absolutely.
All right. So next time we will start in the introduction, which, by the way, was very hidden to me. I think I was 3 or 4 years in before I ever even seen the introduction because of where it's located in the book. It's in front of the table of contents. So I missed it. And it's very, very important. So stay tuned for next time when we cover the introduction. I look forward to it. Jonathan, thank you so much for being here with me today. I appreciate your insights.
Trying to be at least contribute something good to the conversation. So
I certainly appreciate it. And to my listeners out there, thank you so much for listening. If you enjoyed this podcast, I'd appreciate it if you'd like and subscribe, share it with a friend, and you have a wonderful week. Until next time. Thanks for tuning in to the Bankless by Design podcast, where we're done with the system and we're doing money differently. Be sure to subscribe, share this episode with someone who needs it, and visit us at banklessbydesign.com to learn how you can start living bankless by design.